Hello, this is Brian Shannon from AlphaTrends.net. Today is Wednesday, the 7th of May, 2008. The market's closed, and the S&P 500 was unable to add to its gains from yesterday, and it looks as though maybe the longer-term trend is starting to exert some of its force here. So it remains a critical area where this market is right now, below this trend line, below the declining 200-day moving average, and below these December lows. The best bet in here really is to kind of just wait it out and see if this market is going to be able to recover in here. Perhaps it'll find some support near that 200-day, or rather the 20-day moving average, down near support at 138. Doesn't look like it's out of range at this point. That is the 138 level. And then maybe it could build some energy for a retest and then breakout. But right now we have to really keep an eye of suspicion on this market. We can look at this little trend line in here and say that it's holding right at that level right now on a 10-minute time frame. So I'm sorry, on the 30-minute time frame. So you see in here that there's a lot of congestion in this general area. And I think that realistically a continued move down towards 138 wouldn't be unreasonable. We saw that the lower high on this 30-minute time frame after yesterday's rally failed to hold, and that was pretty apparent early on as it broke below this low right here. So we had seen these higher highs and higher lows, and then it broke a lower low right in here yesterday. It was unable to hold above that rising 5-day moving average, and it was also unable to hold below yesterday's lows and that important psychological number of 140. So a lot of reasons to be cautious in here right now. And again, it looks like maybe the importance of this larger time frame at the 140-ish area is starting to exert some influence. And when it's in this area, like I said yesterday, you have to just be very cautious. If you've had some good profits built up here over the last month or so, we are definitely in a very critical area, and you have to think about an exit strategy. Like I've been saying here the last couple days, if you expect nothing from the markets and if you're prepared for anything, then there really shouldn't be any surprises. And what I mean by that is risk management is job number one. When we have this kind of big volatility in here, it typically indicates a turning point for the market. With big volume and volatility, typically comes that emotional turning point. So it pays to be very cautious in here. Now, what I think could potentially happen is maybe we see a rally back up towards 140.5 tomorrow. That area could potentially act as resistance, as it will be the location of this 5-day moving average as well. And then we could see lower highs and lower lows down towards that 138, 138.25 level. So just be very careful in here right now with this market. The financials looked like they were holding on with people buying into the bad news yesterday, but they've given up those gains entirely on the XLF. And you see here we're still holding above this trend line, but looking like it's, again, more neutral. When we have all these moving averages crossing back and forth, it indicates a more neutral market. And the longer term trend, again, if they don't scare you out, they'll typically wear you out, and this market is in need of some healing time-wise. So I think you're probably just best off, unless you're just trading these on the 1 or 2 minute time frames, staying away from the financials for now, and I'm probably not going to continue to update them each and every day. The IWM we saw yesterday made another attempt to push through this key level at $73 a share, and in here we're seeing perhaps also the longer term influence of that area exerting its presence here on the Russell 2000. So again, at a very critical point in here, we've seen this market rallying on diminishing volume, whereas the prior sell-offs came on increasing volume. So that leaves the market vulnerable, and realistically, we're looking at this trend line in here. We're looking at the 20-day moving average, also at about 71.25. 71.25, if you remember, was had been a pretty critical level in here for some time, and now we're back towards that level once again. And I think really breaking back below 71, that's where we want to be a little bit more cautious. Here's the uptrend line that this market has seen since the mid-April lows. It's been tested in numerous times in here. Today it broke down. We do have this lower high, and now we have a lower low in here on the 30-minute time frame. The 5-day moving average is flattened out, so it indicates that the odds are not there for the upside in the intermediate term right now. If we're going to see maybe a rally in here, a short-lived rally, perhaps up to 72.25 or so, and then this 5-day moving average would be turning lower. And if we get a break below that 71.25, then it might lead to a little bit more fearful sell-off that brings it even all the way down to the 50-day moving average. So the dangers are clearly higher in this market right now, and you've got to just treat it very cautiously and begin to look even for some of the weaker stocks that might be good short candidates as well. The NASDAQ 100 was down about 2% in here today. Looking at the 10-minute time frame, because that's where my chart was left, you can see that it's still holding this trend line in here, but we did break below yesterday's lows and is back to that critical level of $48 a share. If we look at the daily time frame, again, this market had broken its downtrend line and the 200-day moving average. Now we're back below the 200-day moving average after holding above it for 4 days. The direction of that moving average is lower, so it tells us we still want to be cautious about the long-term health of this market in here. And it remains realistically a trader's market. And if you're looking for if you're looking at my videos for anything less than short-term analysis right now, I think that to be an investor in this market, if you put on positions for longer-term holds down in here, I think you want to be very careful about thinking about where you're going to lock in gains if this market does fail, because the longer-term time frame does still look like it's reason for concern. This market has found support along the 10 and the 20 and 50-day moving averages here. It's expended a lot of energy on this rally from 44 up to 49. So a little bit further pullback, wouldn't really damage the market. I think that right now it's going to have to get back above 48.5 and hold above there for a half hour or so before you can expect this market to recover. But I think the more likely scenario is that maybe if we get a rally, that this 48.5 area probably ought to act as resistance, and then once it starts declining from that level, if it does, that's when you want to start to look for short, a place to establish short positions in this market. It remains very dangerous in here, and I wanted to show you on this technicalanalysisbook.com, by the way, this look inside button. I think a lot of people have missed this, but what this is it allows you to go ahead and look through some sample pages, and you just simply drag your mouse from the right-hand side of the page, and you can read a few pages in here, look at the charts in there. It's a hardcover book with color charts on the inside, and it's something that I'm proud of, and hopefully you'll enjoy reading.